All right, let's dive into the IPO for BenQ Holding. Now, this is a company with a fantastic reputation for high-end healthcare. But, as we're about to find out, a five-star service doesn't automatically mean it's a five-star stock. Let's break this thing down.
You know, our analysis team came up with this line, and it just hits the nail on the head. The medical world's five-star hotel group. It perfectly captures that premium high-quality feel, but it also kind of hints that you might be paying a premium price tag for it.
So here's the game plan. We're going to start with a great story BenQ is selling to the market. Then, we'll start peeling back the layers, looking at the financial red flags and some interesting governance risks, before we land on our final verdict and what we're actually going to do.
Okay, first things first, what exactly is BenQ Holding? Well, it's a private hospital operator, and it's actually been spun off from the giant Taiwanese tech company CIDI. Its entire business, the whole thing, is built around just two big hospitals in mainland China, one in Nanjing and one in Suzhou.
And listen, when I say their business is built on these two hospitals, I mean 100% of their operations. That's it. Now, they're both in a really wealthy province, Jiangsu, but the Nanjing hospital is the undeniable star of the show. It's pulling in almost two-thirds of the company's total revenue.
All right, let's look at the story they're telling investors. This is the bull case, right? This is the pitch, the reasons why this business looks so strong and, almost unbeatable on the surface.
And the revenue model, well, it looks incredibly solid. It's almost a perfect 50-50 split. You've got inpatient services on one side. We're talking big surgeries, overnight stays. And then you have the high-volume outpatient stuff on the other, handling millions of patient visits a year. It's a classic, time-tested way to run a hospital.
But here's the secret sauce. The key to their entire competitive advantage is this, the Grade A Class 3 license. In China's healthcare world, this is the top of the mountain. It's the highest rating you can get. And for a private, for-profit hospital to get one, that's incredibly rare. It's a huge stamp of approval that builds massive trust with patients. This license isn't just a piece of paper. It's their golden moat.
But, that's the story, and it's a good one. But when we stop looking at the narrative and start looking at the actual numbers, a much more worrying picture starts to form. Let's get into the financial red flags.
And boom, here it is. This slide shows a really concerning trend. See, after they peaked back in 2023, both their gross and net profit margins are clearly and steadily going down. This isn't just a bad quarter. It looks like something is systematically eating away at their ability to make a profit.
So that immediately leads to the most important question you can ask as an investor. What in the world is causing this squeeze on their profits?
Well, the answer is a massive policy change in China's healthcare system. It's called the DRG payment system. Think of it like a tight leash held by the government's insurance fund. Instead of getting paid for every little service they provide, the insurance company now pays one single fixed price for a specific diagnosis. So if your costs go over that fixed price, too bad, you eat the loss. This completely flips the game from making more money to cutting costs like crazy.
And this chart shows you the real-world damage. Just look at how the average amount of money they can make from each patient has dropped at both hospitals. The DRG system is putting a hard ceiling on what they can charge, and it is absolutely hammering their bottom line.
And this pressure exposes some other big weaknesses. First, they have all their eggs in one basket, completely relying on just two locations. Second, with more than half their money coming from government insurance, they're super vulnerable to any other policy changes. And finally, look, they've been around for 17 years and only have two hospitals. It makes you really wonder if they can even grow this model.
But the risks don't stop there. When we look at how the company is run, the corporate governance, another major red flag for us public investors pops up.
You have to understand, BenQ Holding isn't an independent company. It's a spin-off, and it's going to stay firmly under the thumb of its parent, CIDI. So what does that mean for you? It means that your interests as a shareholder might not always be the top priority. Decisions could be made to benefit the giant electronics company, not the hospital.
And this control shows up in what we call related party transactions. The big one here is that the hospitals are buying their medical gear and supplies from other companies owned by CIDI. This is a huge potential conflict of interest. Are they getting the best price on the market, or are they maybe overpaying to help out their parent company, which just squeezes their own profits even more?
So, we've seen the five-star story, and we've seen the troubling details hiding in the financials and the corporate structure. Let's put it all together and figure out what we should do.
I'm just going to borrow a line directly from our analysis because it's so blunt and so true. The company is ridiculously expensive.
And this slide just makes it crystal clear. BenQ is asking for a price-to-earnings multiple of almost 35. To put that in perspective, a big market leader like Huarun Medical trades at just 8 times earnings. I mean, do you really want to pay a valuation that's over 4 times higher for a company with shrinking profits and huge risks? It just doesn't make any sense.
So to be perfectly clear, our decision to pass on this IPO boils down to these 4 things. Their profits are going down, the price is just way too high, the business is dangerously concentrated in one spot, and the way it's controlled by the parent company is a major red flag for us minority shareholders.
Based on all of that, the conclusion is pretty simple and direct. Our strategy is to skip this IPO completely. Instead of putting our money here, we're focusing on other IPOs that we think have a much better shot. We're feeling really good about names like Zhihui Mining and HanXBio. We see them as much better opportunities in the market right now.
And that really leaves us with one final thought. Look, BenQ definitely has a premium brand, no doubt about it. But is that brand really worth paying a massive premium price for, especially when the very foundation of their profits is starting to show some serious cracks? That's the core question every investor has to answer for themselves.